All right, welcome. In this explainer, we're going to break down the powerful forces that make mining stocks so famously unpredictable. We're going to give you a clearer map of this pretty complex landscape.
So, if you've ever kept an eye on a mining stock chart, you've definitely asked yourself this question, right? You see the value jump one day, fall the next, and it can feel totally random. But here's the thing, those moves, they're not random at all. They're actually driven by a combination of really powerful forces. We're talking everything from the global economy all the way down to a single social media post. And today, we're going to unpack them.
Okay, so let's get right into it. We're going to start with the biggest forces, the big picture trends that are completely outside of any single company's control, but, they affect every single one of them.
Think of these four economic drivers as like the weather conditions that every mining company has to operate in. You get a surge in demand for battery metals, and that can lift pretty much everyone up. But a slowdown in China's industrial sector, well, that can create some serious headwinds for the entire industry. And this whole currency fluctuation thing, it's a really fascinating piece of the puzzle, mostly because of how directly it can hit a company's bottom line. See, since most metals are priced in US dollars, a strong dollar can actually make those metals more expensive for buyers using other currencies. That can lower demand and drag down stock prices. Okay, so let's peel back another layer and see how this all builds on itself. Now we're zooming in, from the global economy to what's happening inside the company. Because hey, a rising tide doesn't necessarily lift all boats, right? Yeah, even if metal prices are going through the roof, a company's own performance is a massive influence. I mean, things like hitting a fantastic high-grade mineral zone can send a stock flying. But on the flip side, if a company misses its production targets or its costs get out of control, investors can lose confidence and they can lose it fast. And to really see what I'm talking about, here's a recent case study. It involves a Canadian lithium company. So, what's the takeaway here? The crucial point is that in that moment, operational execution, just hitting a deadline, mattered way more to investors than the strong commodity market. It really shows you that fundamentals inside the company can easily override the bigger economic picture. And there's another piece to this company-specific puzzle. We can't forget about regulations. A newly granted mining permit can make a stock climb, for sure, but new environmental rules or unexpected tax hikes, that can increase risk and push the stock right back down, and it often happens with very little warning. Okay, now for the final layer. And honestly, this might be the wildest, most unpredictable force of all: human emotion and market sentiment. This is where things can get really interesting. This is where stock movements can just completely detach from company performance or commodity prices. It's the buzz, right? The story, the hype. And in the world of mining stocks, especially the smaller ones, that can be an incredibly powerful force. For instance, a single post like this one, it might not even contain any new fundamental information, but it can create a sudden rush of trades just by drawing a ton of attention to a stock. And what happens next? Well, the result of that attention can be absolutely staggering. A stock can surge on pure hype, completely disconnected from a new drill result or a financial report. It's just a reminder that at the end of the day, markets are made of people, and people are influenced by stories. Okay, so knowing that all these different forces are constantly at play, what are you supposed to do about it? How do you manage this volatility and make smarter decisions without just getting swept up in all the noise? Look, the key here is to have a playbook, a system. Following a clear set of strategies like these can help you avoid those emotional reactions. So, instead of panicking when there's a dip, you check for operational updates. Instead of chasing a headline, you look at the company's actual financial health. At the end of the day, understanding these patterns is what helps you stay grounded. It lets you see the market's volatility for what it really is, a mix of economics, performance, and psychology. And it positions you to make patient, informed choices for the long haul. By taking the time to really get the why behind those wild price swings, you move from just watching the numbers to actually understanding the story they're telling. And believe me, that makes all the difference.